Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Analysis of big tech valuations, quantum computing mandates, and July market projections. This video presents a direct informational narration of the source document. Here is a quick look at the agenda. We'll be covering a market and oil overview, quantum computing, big tech's AI spending, valuations, and institutional selling, and wrapping up with the Q2 rebalancing and July outlook. Let's get right into it. Starting with the broader market, the S&P and NASDAQ closed lower, while the Dow and the Russell indices managed to record slight gains. When we look at sector performance, we saw some real strength in real estate, REITs, energy, and healthcare. On the flip side, communication services and consumer discretionary sectors lagged behind. Google, in particular, experienced a notable decline. This was influenced by news that a key data scientist from Google DeepMind actually left to join their competitor, Anthropic. In fact, all four major tech companies traded lower. Now, pivoting over to the energy markets, Brent crude oil dropped below the $80 mark, hitting $78 intraday before it tried to make a brief recovery. So what's causing this price pressure? It stems from geopolitical developments. Iranian officials reported significant progress in talks with the United States in Switzerland, a development that was actually praised by Qatari and Pakistani military representatives. Adding to this, the U.S. administration confirmed that the Strait of Hormuz remains open. They also stated that Iran agreed to the return of International Atomic Energy Agency inspectors, though it's worth noting that Iranian media reports have contested that specific detail. Ultimately, the U.S. Treasury Department issued a general license suspending sanctions on Iranian energy production, delivery, and sales for 60 days. This allows Iranian oil to be sold openly. Moving to our second section, the quantum computing push. The source document outlines that the U.S. government signed two executive orders aimed squarely at accelerating quantum computing development. The first directive mandates the deployment of the very first quantum computers sufficient for scientific research at a national laboratory by 2028, which importantly coincides with an election year. The second directive focuses on speeding up the government's transition to post-quantum cryptography, and they're targeting completion by 2031. Over on the commercial side of things, IBM currently projects the launch of a fault-tolerant supercomputer by 2029. Following these executive orders, IBM stock actually rose 5% in after-hours trading. It reclaimed a previously broken support level to reach 265, and the stock now faces overhead resistance between 295 and 313. Now, historically speaking, public-private technological partnerships in the U.S. have yielded mixed results, often presenting challenges for purely commercial entities. However, an increasing number of companies in semiconductors and quantum computing are actively aligning with national strategic directions to secure that government support. Let's move on to Section 3, Big Tech's AI spending. Focusing on the four technology giants, Google, Amazon, Microsoft, and Meta, these companies operate massive hyperscale data centers and essentially function as the primary purchasers within the current AI ecosystem. While AI definitely generates some revenue, it doesn't currently cover their substantial investment costs. Because of this, their free cash flows are progressively turning negative. You see, the core logic of the entire current AI hardware and software supply chain depends almost entirely on the capital expenditure expectations of just these four companies. They are the buyers literally funding the entire downstream AI supply chain. If they encounter financial pressure and choose to reduce their computing power investments, their capital expenditure expectations will decline. That will directly reduce the revenue expectations for all the downstream supply chain companies that are relying on this spending. Next up, Section 4, a breakdown of tech valuations. Analyzing their specific valuations, Google's forward price-to-earnings ratio is sitting at approximately 24 times. This is higher than the broader S&P index, but it actually remains reasonable compared to its own historical average. The stock is sliding toward a potential support range of 131 to 132.5, having recently traded near 134.8. Then we have Amazon. Its forward PE ratio is roughly 25 times, making it the highest among the four, and it's seeking technical support around the 224 to 216 range. Microsoft holds a forward PE of about 19 times. That's slightly below the S&P average of 20 times, and historically low for the company as it waits for support below 375. And finally, Meta is the most undervalued of the group. It has a forward PE of just 16 times and is testing support areas near the 500 level. This brings us to some interesting institutional selling trends. Regarding short-term capital flows, data from Jefferies indicates that their trading clients sold approximately $6 billion worth of the 7 megacap stocks over a recent 20-day period. To put that into perspective, this marks the second worst 20-day sell-off for these equities in the past 2 years, surpassed only by an $8 billion sell-off we saw in March of this year. This sheer level of institutional offloading indicates a severe selling imbalance. It suggests that the selling pressure may actually be nearing a peak and buyers could soon step in to rebalance. Ultimately, the fundamental test for these companies is going to be the monetization of AI, which is expected to be validated by the fourth quarter earnings reports early next year. Elsewhere in the market, SpaceX briefly touched the 150 price level, experiencing a 30% turnover as speculative positions cycled out. Let's look at Section 5, End of Quarter Rebalancing. Looking at the broader market transition from June to July, a report from Citadel Securities provides some really key data. For context, they handle over 20% of U.S. equity trading volume and serve as the designated market maker for 62% of NYSE-listed companies. As the second quarter ends, asset allocation funds are significantly overweight in equities and underweight in bonds, mostly due to the recent market rally. Get this, the top 100 U.S. pension funds currently boast a 111% funding ratio. That is the healthiest level since 2001. Naturally, highly funded institutions prioritize risk reduction over aggressive growth. Consequently, to return to their traditional 60-40 asset allocations, these funds must execute mechanical, non-fundamental selling of stocks to purchase bonds by the end of June.
So how does this play into July seasonality? Let's take a look.
This negative fund flow is expected to reverse starting July 1st. Retirement funds, target date funds, and systematic strategies will resume passive allocations and buy into the market for the second half of the year. And historical statistics definitely support this seasonal strength. Since 1928, the S&P 500 has risen during the first half of July 69% of the time. The NASDAQ 100 has posted gains in 17 of the past 18 years during this period, representing an impressive 76% probability. Now, while historical probabilities absolutely do not guarantee future performance, the mechanical fund flows heavily favor market strength entering early July. However, there are some warning signs we need to discuss. The Citadel Securities report outlines several vulnerabilities for the broader market. First, habitual buy-the-dip behavior generally stops when the VIX approaches 30. Currently, it sits calmly below 20. Market breadth is also showing a negative divergence. Only 54% of stocks are trading above their 50-day moving average, down from 60%, even as the major indices continue to rise. Additionally, if the Federal Reserve provides less forward guidance, the market may demand a higher risk premium, pushing the 10-year Treasury yield higher. A rising 10-year yield negatively impacts the discounted cash flow models of technology stocks, putting direct pressure on their valuations. Finally, the market is highly top-heavy right now. The top 10 companies by market capitalization currently account for nearly 40% of the S&P 500's total weight. If these mega caps decline, the broader market will seriously struggle to maintain its current levels. So, looking at all this data, the real question is, can big tech maintain its spending to hold up the broader market? We'd love to hear your thoughts, so be sure to share your insights down in the comments.